Welcome back. In our top business story, the UAE and Qatar markets missed out on their third bid to upgrade to emerging market status today. A success in the latest MSCI classification review would have meant a significant cross-correlation with international markets. And as a result, the UAE will continue to excel in correlating with regional and European markets, according to experts. The classification will, however, remain under review for another upgrade next June. The review this time around was postponed for 6 months to allow investors to ease into a new settlement system, delivery versus payment, where MSCI feedback was positive. An MSCI statement said that investors continue to stress concerns over the effectiveness of the new framework to fully ensure the safeguarding of their assets under certain circumstances, particularly for failed trades where a forced sale of assets without the owner's consent remains a possibility.
The MSCI decision was to keep the UAE in the Frontier Market Index, but the market was up for review again in June 2012. Generally, the comments by the MSCI on overall institutional feedback and the improvement in the new DVP process were positive. However, they did highlight certain areas for improvements, and they're mostly related to the failed trade resolution process in the UAE. I cannot say that this decision was completely a surprise to the market, as investors were almost 50-50 on it. The market is down today, with large caps such as Amar and FGB continuing to underperform. But I have to say that partly this weakness in the market is due to weakness in the global markets, that's not only linked to the MSCI issue. Now, going forward, I think the MSCI upgrade will not be a focus point for investors until we get closer to the June review. We still think that the UAE has a great chance to be upgraded as authorities continue to improve, if you want, the settlement environment. And one recent example of this is the draft regulation by ESCA regarding the introduction of short stock borrowing and stock lending, and that would be a measure that will mitigate the risks highlighted by MSCI. So we'll take the view that in the next 6 months things might be better, and the UAE could be upgraded again.
The Dubai International Financial Centre hosted its second seminar with the Madrid Centro Financiero to discuss further financial cooperation between the UAE and Spain. The second meeting was opened by Abdullah Mohammed Al Awar, the CEO of the DIFC authority, and comes off the back of an MOU that was signed between the DIFC and the MCF in September 2010. The UAE is Spain's largest export market to the Middle East, and annual exports are around €1 billion. His Excellency Abdullah Al-Sali, the Undersecretary for the Ministry of Foreign Trade, stated that bilateral trade between Spain and the UAE has been growing at an annual rate of 15%, reaching an impressive 2.5 billion dirhams in the first 6 months of 2011, with the UAE exporting goods worth 88 million dirhams, re-exporting 226 million dirhams, and importing 2.1 billion. He stated that through the creation of new partnerships and mutual efforts, they hope to boost these figures even further in the coming years. And off the back of the MSCI review, let's take a look at how the UAE markets reacted, as well as the GCC markets. We have Bruce Powers, the head of research at Trust Securities, in the studio with us. Welcome to the show today, Bruce.
Hi, Laura. Good to see you.
So is this a sign that investor appetite for the Hong Kong IPO market has run its course, do you think?
Well, it wasn't just those IPOs that you mentioned earlier in the week. There were also other problems. One IPO was pulled, another lowered their offering. And then yesterday, 2 IPOs came out, and they both ended lower, one down over 10% and the other over 30%. So right now, the outlook is gloomy and uncertain due to Europe, and it's weighing on investors, and that very well could continue into the first quarter. Overall, the outlook on the market right now is one of a little bit of mistrust. The Hang Seng is down around 22% for the year and about 28% from the high. We had a nice rally off the bottom in early October, and it's been weakening since then. It's not really the best time to IPO, as the trend has now turned down, and it very well could get below that October low.
Now, the European debt crisis has impacted Hong Kong. What about China?
Well, there's a big concern about China and the degree of slowdown that we may see due to the debt crisis and the impact on world economies. As you know, China's got one of the largest economies in the world. They provide many goods to many countries, and they're also the largest source of demand for commodities. Now, there's two basic issues. One is, what is the impact going to be on China from slower demand in Europe, and the other one is the impact on a slower real estate market. Now, there are some people who are saying that there's a bubble, a real estate bubble in China. Authorities have been tightening credit over the last year to slow speculation in hope of having a mild slowdown. Real estate has come down already about 10%. Some estimates have it coming down as much as 50%.
Right.
And all we have to do is look at what happened here in the UAE to see the potential impact of that.